Welcome, ladies and gentlemen, to our main lecture. Last week, we had some introduction to the course and the content of what we are supposed to do in the next 3 or 4 months in preparing for the exams. We went through the number of hours that we are supposed to do, and we said at least 1 hour, 30 minutes, and they will be convenient and will help you prepare fully for the exams. We also looked at the materials that we are supposed to use. We spoke about the international tax primer, and I told you that it's a good basic source book for understanding the various concepts that we'll be discussing. So by now, I'm expecting that you get this book and start reading them. We also said that one of the major books that we'll be using is this Model Tax Convention on Income and Capital. We will use it a lot when we are discussing double taxation treaties. When we get to transfer pricing, the major book that we'll be using is the OECD Transfer Pricing Guidelines for Multinational Enterprises and Tax Administrators. And like I mentioned, if you have the OECD Model Tax Convention, we will have to also use the Ghana double taxation treaties. So we have all the tax treaties that we'll be going through. Past questions, you can't ignore them because always there's a repeat of past questions. So I'm expecting that you get a past questions and then you look at the nature of the questions and what is expected of you during the exams. For the United Nations Double Taxation Conventions, yes, we will once a while look at it, and then the transfer pricing guidelines will have once a while look at it. But like I mentioned, they are almost the same with minor variations. So we also talked about the fact that international taxation is, an interesting subject to study. And now that we are having a lot of multinationals trooping into our country, even the World Bank and the IMF are insisting that we should be able to raise our own internal revenue. Internally generated revenue to support our budget. So international taxation is getting serious attention at the international level. So we will be discussing a lot of issues. Some of them are very current. You can look at the OECD base erosion and profit shifting. We'll be looking at all those things in this subject. So let me go straight to what we want to do today, and I believe that you remember what we discussed last week. We can't do international taxation, or we can't go international when we are not familiar with our domestic law. So we had some introduction to our domestic law last week and how the tax system has changed over the years. We want to continue on and look at the Income Tax Act, how it looks like domestically, and then how it transitions into the international level. We'll be talking more of jurisdictions to tax. So that is how we want to go. We want to start from the domestic level and then we move into the international taxation. Good. So last week we mentioned that you have to look at the merger of IRS, VAT, and customs. I wouldn't want to go over this thing again. And so the Ghana Revenue Authority Act, I'm expecting that by now you have looked at it. Where I want us to start and how and why we expect you to know something about taxation is taking a second look at the core functions of the Ghana Revenue Authority as established. So the GRAs, if you look at section 3, a number of objectives or functions have been stated, but I want us to summarize it for purposes of this lecture or for purpose of this exam. So I want us to look at 4 core functions. So the GRA core function, one of it is to first identify all taxpayers, and this we call the TIN registration or tax identification number. We all know what is going on now, the linking of the old TIN to the Ghana card. In other words, you can't collect taxes if you don't know the people. So the first thing that anybody should do is that, look, let's identify our people, our customers or taxpayers. After the identification, then you do assessment of the taxes. Is anybody owing tax based on some activity that he has undertaken? So it is about assessment. How do we assess the taxpayer to taxes and levies as the law provides? So in this subject, we are expecting that you learn about how do you assess taxpayers who have international transactions. Okay, so somebody has come to Ghana, has conducted business, and the law says that he must pay tax. How do you go about it? How do you assess the person so that he will pay the tax to Ghana? So after the assessment, you will notice that we need to collect the taxes. So in the collection, it's more about administrative procedures. So we tell them the time of payment of the taxes, and how they should pay it. If they don't pay it, what do we do? Are there penalties that we can impose on them? So these are matters that we will be looking at along the line. Then after the amounts are collected, the law says that we should pay it into the consolidated fund for usage. That big bowl, that big fund that sits with Bank of Ghana. So this here, we don't expect you to learn anything, because as for payments, we just have to give you the bank account. So GRA will tell you that pay into the GRA account, and that is it. So clearly, the work that is required of you is more or less on the 2 and 3. As for tax identification, it's just a matter of filling the forms, and then so be it. Then we are okay. So we're going to learn or spend time on assessment. How do we assess taxpayers to the various taxes that we have in Ghana? And then after that, what are the administrative procedures we put in place to tell the taxpayer we have assessed so that he can go about the payment, and how do we collect it? If they don't, what do we do to them? So we want to first look at the domestic law, the Income Tax Act. Like I mentioned, this is a major law that you must get. Fortunately, it is not a huge document. It's about 133 sections. So even if you are reading 10 sections a day, within 13 days you should be able to finish reading this law. And 133 sessions, including interpretations and some schedules. About 6 of them, used to be 7. The 7th schedule has been repealed, and so it's quite a very simple document for you to read. Now the caution here is that tax laws are a bit complex to read and understand, and so if you read the first time and you don't get it, you need to read it again and try to pause along the line and try to understand what they're trying to say. And they speak to each other. So section 1 will be speaking to, let's say, section 100 and section 130, or they speak to each other. So try and draw the line between the various sections that you'll be going through. So today we want to look at least 3 main sections, then we can see how we can jump to the other sections. So the first section is normally the imposition, and like I mentioned, taxation is a compulsory thing, so you need to impose it on them. If you impose it, then somebody doesn't have an option, and something imposed means that it has a constitutional backing, so failure to comply with it should attract some sanctions or penalties. So section 1 is usually the imposition, and some say it is the charging provision. That is the law that charges it. So anytime you are reading a tax law, look at the charging provision. And then after the charging provision, then the following the other sections that support the charging provision will be the mechanics to deal with the tax imposed. So section 1 says that income tax, and again let me explain here. Here we are talking about income tax. We're not talking about all other taxes. In some other lectures we'll be talking about the various taxes that we have in Ghana. Here we are talking about income. It is only income, and like the name of the act says, it is income tax. So we are dealing with only income. When we come to value-added tax, we'll be talking about value-added tax separately. When we come and talk about airport tax, it's a separate thing. If we're talking about communication service tax, it's a separate thing. Here we are talking about income tax. So subsection 1 says that income tax is payable for a year of assessment. Now look at it. So it says that the income tax that we want to impose, it must be paid for each year of assessment. If you remember, I told you that in your study we want to teach you how to assess taxpayers, and this assessment we do it yearly, every year. So each year of assessment we do an assessment. So let's say Johnson has income for the year 2020. We need to assess Johnson to income tax for the year. So that 2020 becomes the year of assessment. So if you have any income, anybody who has an income and he is supposed to pay tax, we are saying that the income tax must be paid for each year of assessment. Now A says that by a person who has a chargeable income, and I've underlined the word chargeable income for the year. And please pay attention to the word person, because we'll come and look at the various persons that we are talking about here. Okay, so he's saying that any person who has a chargeable income for a year, he must pay tax for the year. And B says a person who has a final withholding payment. I've also underlined this one, but I will pack this final withholding payment concept. We'll come to it later. Okay, let's first take the A. The A says that you must have a chargeable income for you to be subjected to taxes in Ghana. Now again, let's try to understand the word chargeable income. So I'm going to suspend all the other provisions for now. It doesn't mean that you shouldn't continue reading it, but let's go to chargeable income. What do we mean by chargeable income, even if we take only the A? Because it says that a person who has a chargeable income for a year has a tax imposed on him. Section 1 just mentioned chargeable income. But if you want to understand the chargeable income, then we must go to section 2. Okay, and section 2 defines what a chargeable income is. Now section 2 says the chargeable income of a person for a year of assessment. And again, he's mentioning the year of assessment here. So pay attention to that one too. So the chargeable income of a person for a year of assessment is the total of the assessable income. See that he now introduced another form of income here. So we now have the chargeable income and then assessable income. So if you have an assessable income of that person for the year, and then he says from each employment, business or investment. So almost like two things have been introduced here when we're trying to understand what a chargeable income is. He's saying that your chargeable income is the total of your assessable income, and it must come from employment, it must come from business, and it must come from investment. So more or less, these are the sources of income. And let me say that the word income has not been defined in the tax law. The reason is very simple. It's a very complex term, because the various professionals have never agreed on what constitutes an income. Lawyers have their own way of defining income, and they are right. Economists have their own way of defining income, and they are right. And accountants also have their own way. So one judge said that, look, the word income is not defined, but when we see it, we will know that it is an income. So the only way we can do, or the simplest approach we can take, is that let's identify the main sources of income. And that is what we are saying, that the main sources or the main pipelines for which we want to slap tax on is that the income must come from employment, it must be from business, or it must be from investment. For these ones, we are capable of defining them, and even the definition sometimes is not too clear. So we use the word inclusive. So anytime you see the word include, so for example, if you are defining business, it's one of the controversial terms to define. So we will not define it as means. We will not use the word means, because if you use the word means, then it means that you are trying to specify the limits. But if we say business includes, then we leave it open for us to be able to include anything that looks like it to be included. So we are saying that your assessable income must be from employment, business, or investment. If we get that one, then we know that their chargeable income is equal to your assessable income. Okay, then it continues, less the total amount of deduction allowed under this act. So your chargeable income must be your assessable income, which is from employment, business, or investment. Then we take out the allowable deductions. Now the word allowable deductions or deductions allowed means that there are certain deductions which are not allowed. So if the deduction is not allowed, we will not take it out when we are determining your chargeable income. So in simple terms, what we are trying to say is that you must pay tax on your chargeable income, and your chargeable income is your assessable income less allowable deductions. You will notice from section 2 that assessable income is also not defined. So we have to go to section 3 and look at what is assessable income. Great. So we go to section 3. Section 3 now says that the assessable income of a person for each year of assessment is the income of that person from employment, business, or investment. So he brings the 3 sources of income here too. So what he's saying is that if you want to assess somebody, or you want to, let's say you want to assess Justin, or you want to assess Aaron, look at his business, look at his investment, and look at his employment. Any income that comes from this one is his assessable income. So his salary and other allowances from his employment is 20,000. This is income from employment. Maybe he did business and he made some income, profit or whatever, then 10,000. This is his income from business. He did some investment. Let's say he invested in men's good or whichever. Then he got some income, 2,000. This is income from investment. Then the law says that these are his assessable income when we want to assess him. But mind you, we have said that chargeable income is the income that we are going to apply the tax rate to. In other words, that is the income that we must charge the tax on. And that's why we call it the chargeable income. So the income that we are going to charge the tax on, if it is 10,000, if your chargeable income is 10,000, if we apply the tax rate, let's say 25%, then we get 2,500. So this becomes the tax liability that you are going to pay. So to get a chargeable income, it is the assessable income, take all expenses that are allowed, then you get your chargeable income. But to get the assessable income, we look at your employment, your business, and the investment. Great. Now we are making a little transition to the international environment because the word we use under section 1 is a person, and a person in taxation connotes 4 main categories. So we have an individual, we also have partnership, we have trust, and then we have companies. Companies, we are told, the lawyers tell us that it's an artificial person. So the person that we are talking about here is this 4 categories of persons. So we are saying that if you want to determine the assessable income, you've got to be careful because there's something we call jurisdictions to tax. Okay, as we sit here, we can't go and tell American citizens to come and pay tax in Ghana. No. Yes, we have the power under the Constitution to impose the tax under Section 1. And Section 1 says that tax is imposed for each year of assessment by a person who has a chargeable income, but you can't apply it to everybody. If a Canadian citizen is in Ghana and for some reasons he brought some money or something, you've got to be careful when you are trying to extend your long hand in taxing people. So Section 3 subsection 2 is very, very important for international taxation. We need to make some distinction here. And let's look at what it says. It says that the assessable income of a person for a year of assessment from any employment, business, or investment is A in the case of a resident person. Now we are trying to bring the distinction. We are saying that if you want to do the assessment, first look at a resident person and then a non-resident person. And this is where the jurisdiction to tax comes in here. You can't exercise your right over somebody's income when you don't have power to do that. You lack jurisdiction. So we are saying that if you want to do the assessment, in the case of a resident person, look at the income of that person from each employment, business, or investment for the year, even whether or not the source from which the income is derived has ceased. So as long as you're a resident person, and we'll come and look at this concept very well because they are important concepts that we need to appreciate, because they're going to run through all the discussion in international taxation. So the concept of resident is very, very critical here. But here, at this level, let's just understand the basic meaning of resident as maybe Ghanaians. Simple. It's a very loose way of describing resident. But as long as we go along, you understand that resident connotes bigger things than just a simply Ghanaians. Even under Section 101, we'll come and look at who a resident person, because the law has defined it. So if you are a resident person, your worldwide income, we are going to see it as assessable income, and we are going to subject it to tax. What that means is that as long as you're a resident, whether the income is coming from Ghana or Canada or Australia or Singapore, it is subject to tax in Ghana. And even if the source has ceased, so you were working, your employment got terminated, then you came home, then some years later you are told that, oh, there was some money that you should have received, so the money has now come. Yes, the employment has ceased, but the income is coming. The law says that whether or not the source has ceased, it is still an income, and we must add it to your assessable income. So that is resident. Now, when you are looking at non-resident, the matter is different. So B says that in the case of a non-resident person, so now we have two types of persons, resident person and non-resident person. And non-resident here is also not the ordinary meaning of resident, non-resident. We'll come and look at it in detail. So in the case of a non-resident person, the income of that person from the employment, business, or investment for the year. Yes, but we need to go further. To the extent, and these words are very important, if you are non-resident, to the extent to which the income has a source in this country, that is the only way we can exercise our power, our jurisdiction over your income. So if you are non-resident, the income must have a source in this country. In other words, you must get that money from our country. So if the income is from this country, it means that we can add it, we can consider it as assessable income. And the II goes on. He said, where the person has a Ghanaian permanent establishment. So I've put those in red because they are going to run through our discussion. This is just the introduction. And this one, nobody will examine you on. It's too fundamental for any examination to be conducted on this. So if you are non-resident, it's either you have the income source from this country or you have a Ghanaian permanent establishment. And we are going to discuss permanent establishment very well in detail. Then the income from the year that is connected with a permanent establishment, irrespective of the source of the income. So what I want you to appreciate here is that subsection 2 is very important. Know that in trying to impose the tax, you need to distinguish between resident person and non-resident person. For resident persons, their income is subject to tax. Wherever it's coming from, they are subjected to tax. And it doesn't even matter whether the source has ceased or not. As long as we see it as an income, we must tax it. For non-resident persons, you have to be careful, because if the source of the income is not from Ghana, you can't. Imagine somebody just landed in Ghana with 10,000 pounds on him. The income is not sourced from Ghana, and GRA decides to say, oh, hey guy, you have money in your pocket, we have to tax you. I mean, that would not be proper. As long as the income has no source in this country, you can't. And the person is also not having any Ghanaian permanent establishment, you cannot. So for Ghanaian permanent establishment, we will be reading section 110 of Act 896, and then we'll understand it better. So at this point, there is resident and non-resident. What does it mean? Let's go to section 101 to understand residents and non-resident. Okay. Section 101 is very important because it gives us the understanding of the local law, and when we begin looking at the international law, it sort of reflects what we have locally. So section 101 has 4 main subsections, and each of them speaks to the persons that I spoke about. So we are going to talk about resident individual, resident partnership, trust, and companies. These 4 persons, they must be residents or non-resident, and it is automatic whether you are a resident or non-resident. So first of all, let's look at resident individuals. And please, we are doing this to understand the section 3 we just read. Okay, so don't get lost. We are from section 1. We are imposing the tax. We are saying that you must have a chargeable income. Then we didn't know what is the chargeable income, so we came to section 2. And section 2 said that chargeable income is equal to assessable income less all expenses that are allowed. That's section 2. We didn't also know what is assessable income, so we came to section 3. So section 3 is saying that the assessable income is all your income, or the income from employment, business, and investment. But he didn't end there. He went ahead to distinguish between resident and non-resident, because you can't lump them together. And if you put them together, it will mean that anybody who has income at the airport or any money in his pocket at the airport, we must be able to enforce this law, and that is not possible. That's why we are distinguishing between resident and non-resident. And we said that for resident persons, the income is taxed everywhere. Wherever the income is coming from, we must tax it, even if the source has ceased. That is resident. And there's a reason for saying that. And then for non-resident, we are saying that we can only tax them when the income has a source in this country, or the income was generated from a permanent establishment. We'll come and look at it. So we're now trying to understand what a resident is. And resident, as provided under section 101, is in 4 categories. The first category deals with the subsection 1. And we are dealing with individuals. That's the natural persons. Now, 101 subsection 1 says an individual is resident in the country, that is Ghana, for a year of assessment if that individual is a citizen. So if you are a citizen other than a citizen who has a permanent home outside of the country and lives in that home for the whole of that year. So as long as you are a citizen, you are more or less our child. You belong to us. So why don't you pay tax? And these are based on some principles. You are in a country where you are a resident. You know, the purpose of taxation is to provide for society, the common good. We all contribute so that we'll be able to pay for the police to protect us, we'll be able to construct the road for all of us to drive on, we're able to provide electricity at a subsidized price, provide the hospitals. So if you're a citizen, you must pay. And that is why we don't consider where the income is coming from. As long as you are a citizen, government doesn't work. As long as you're a citizen, bring the money so that you contribute your share. But if you're a citizen and you have a permanent home outside of Ghana, then for that year of assessment, that year we want to assess you, we will not consider you as a citizen. It doesn't mean that we are not going to tax you. As long as you fall in the category of a non-resident, we will now have to go to the next step and say, did you earn this income from Ghana? If the source is from Ghana, yes, we must tax you on it. So a citizen other than a citizen who has a permanent home outside of the country and lives in that home for the whole of that year, so the whole of the 365 or 366 days, you never step foot in Ghana, though you are a citizen. And citizenship is defined by the lawyers. You know, we have a Citizenship Act, so you must qualify to be a citizen. Then this one applies to you. So that's the first criteria for determining who a resident person or a resident individual is. Section 101, subsection 1. B continues to introduce another concept. Here, he's not talking about citizenship. He's saying that present in the country during that year for an aggregate period of 183 days or more in any 12-month period that commences or ends during the year. So again, here we have moved to the citizenship and we are trying to connect the individual to the country. So we call them the connecting factors. Connecting factors. In the first instance, we're able to connect you to the country using your citizenship. In the second factor, we are connecting you using your physical presence, your physical status. So you are in Ghana for 183 days. This is enough for us to consider you as a resident. Under normal circumstance, tourists, when they come, the maximum they can stay is 90 days. But you have gone 183 days, which is 6 months. 6 months is enough. You have enjoyed our road, you have enjoyed our security, so we need to put you in the category of a resident person. So if you are an individual, citizenship or physical presence for 183 days, and it can commencing or ending at any time when we're able to count 183 days or 6 months within any 12-month period, we are saying that you qualify to be a resident person for tax purposes. Now, C also introduced another interesting concept. It says that an employee or an official of the government of Ghana posted abroad during that year. Yes, official of government of Ghana. As for them, they are automatically residents. They are working outside Ghana, the embassies and all those. We pay them with Ghana money, so they must pay the taxes in Ghana. In other words, we consider them as residents. So, though you are not physically present, but as long as you are an employee or an official of government of Ghana and you are working in the embassies, the international law even states that the embassies are territories of Ghana. So there's no confusion about it at all. Sometimes the confusion comes with the B, the 183 days rule. And then D says a citizen who is temporarily absent from the country for a period not more than 365 continuous days. So you are a citizen, but for a very short time you are outside Ghana, and you have been out of Ghana not more than 365 days. So if you come 364, you fall within it. So these are the rules that helps us to define who a resident person is. If we're able to apply these rules, then we can bring you under section 3 to come and apply the law to you. So that is individual. Now let's go to partnership. How do we know a partnership is a resident partnership? and that is provided under subsection 2. It's saying that for the purpose of this act, a partnership is resident in the country for a year of assessment if any of the partners resided in the country at any time during the year. So that's how we know that you are a partnership. If any of the partners is in Ghana, we will come and learn under section 50, 52, 53 to 56 that partnership is not taxed. It is the individual partners who are taxed because they make up the partnership entity. Those of you who remember in partnership, when they finish, they share the profit or loss. So it is the individual partners. So as long as any of your partners is resident in Ghana, and here it is an individual. So if any of the partner is a resident according to subsection 1, then the partnership is considered as a resident partnership. Let's move on to trust. Trust, we don't normally see trust in Ghana, but in somewhere trust is a very huge business. So a trust is resident in the country for a year of assessment if that trust is established in the country. In other words, the trust has, the establishment is in Ghana, the registration and everything is done in Ghana. Or the trustee or any of the trustees is resident in the country at any time during the year. So here we know that trust is managed by trustees. So if we're able to identify that a trustee is resident in Ghana, then that makes the trust a resident trust. Or C, a person resident in the country directs or may direct senior managerial decisions of the trust at any time during the year, whether the directive is given alone or jointly with other persons or directly or through one or more interposed entities. So you may not be a trustee, but you are a manager of the trust, and you are in Ghana and you are managing the trust. That also makes the trust a resident trust. These are all important concepts because they will determine whether you should include all income in the assessable income or you should focus only on the income that has a source in this country. Then the last one talks about companies. So it says that a company is resident in the country for a year of assessment if that company is incorporated under the Companies Act. We need to change this one because now it is going to be Act 992 2019. So no more Act 1963 Act 179. In the law you see it Act 179, but because of the change in exams we don't expect you to write 1963 because that will be a dead law. So if the company is registered in Ghana or incorporated, we go to the Registrar General and we're able to tell that the company has registration document, then automatically the company becomes a resident company. It's possible that the company may not be registered, but it is managed from Ghana. Nowadays, computer and IT systems enable people to register company in Ghana, and then the management is done in Mauritius. It's possible. So for tax purposes, we are saying that B, the management and control of the affairs of that company are exercised in the country at any time. And this one is a favorite examination clause. We'll give you a lot of facts, and part of it, you see that part of the company is managed from Ghana, and then the board of directors are sitting somewhere, and a mixture of issues. Then we'll tell you, should the company pay tax in Ghana? Sometimes the company will say they are not subject to tax in Ghana because they are not in Ghana. You will now have to come and apply the law and identify whether the company is in Ghana. So the company is not established in Ghana, but effective management is from Ghana. That means that the company has residence in Ghana. So let me recap. I don't want to have a very long video so that you can finish listening to it and then you move to the next one. We are saying that among the core functions, we are going to learn how to assess the assessment of taxpayers. After the assessment, we'll do the collection of the taxes. For the payment to consolidated fund, it doesn't concern us too much. We have looked at the imposition of tax, and we are saying that tax is imposed on any person who has a chargeable income. I deliberately suspended the B portion with this with final withholding payment. We'll come and take it later. Kindly read the other sections that follow under section 1. In order to understand chargeable income as stated in section 1, you need to go to section 2. Section 2 will tell you that the chargeable income is the total assessable income from employment, business, or investment, less deductions allowed. Now, we have also said that employment, business, and investment are the main sources of income, because you can't define the word income. It's difficult to clearly define it. So normally you just tell us the sources. When we see the income, we will know it. And this assessment is done in a year of assessment. And the year in which we do the assessment is what we call the year of assessment. We also try to understand the assessable income. We say that the assessable income is the income from employment, business, and investment. But when it comes to resident and non-resident, there's the need for us to distinguish it. And this subsection 2 is the basis for the jurisdiction to exercise our rights over some people's income. So if you are a resident person, and because you are our own child or your own Ghanaian born baby or person, help develop the nation, and therefore we slap tax on every income that you have, whether worldwide, whether it is coming from USA or what, as long as you're a citizen or you're a resident person, we'll slap the tax on you. And it doesn't matter whether the source has even ceased. For non-resident persons, there are only 2 ways we can exercise our jurisdiction if the income has a source in this country. After all, if Ghana is an island, you wouldn't have made that money. So if it has a source in this country, we'll have to slap the tax on you. And if it has a permanent establishment, the income is from a permanent establishment, we can also take the tax on you. We try to understand what this resident and non-resident persons is. So we went to section 101. We have looked at the resident individual, we have looked at resident partnership, we have looked at resident trust, and then we have also looked at resident company. So we'll end here and then we'll continue another time. Kindly read the various sections that we have mentioned, and then make sure that you finish reading the subsections that come under them. These concepts are very important, and they are going to run through the proper international taxation that we are going to do. I thought that we should look at the local regime before we go into the international environment. Thank you very much, and see you soon.